Chapter 11, PFRS for Small and Medium-Sized Entities.
Differentiation between full PFRS and PFRS for SMEs. Parehas po silang set of standard para po ma-assure ang consistency in recording, recognizing, and measuring financial transaction. Kung saan kapag ito ay ginawang guidelines ng isang entities, magagaranti ang stability and promote transparency throughout financial reporting. Process of the entity, so kapag full PFRS ay complicated po dahil ito ay kabuuan ng isang standard to help every business investors para magkaroon ng maayos at tamang pagpre-prepare ng financial reporting every period, while PFRS for SMEs are also set of standard that only meant for use of SMEs, or the other words, it is more complicated in full of PFRS, while PFRS for SMEs is simplified version po siya ng full PFRS. Mamaya po meron din po tayo ma-encounter na PFRS for small entities. Ito ay mas pinasimplified version ng PFRS for SMEs. Of the PFRS for SMEs, ang una ay threshold na set dapat ay total asset ay within the range of 3 million to 350 million, and the total liability ay 3 million and 250 million. Once na naging below sa regis na yon, meaning nasa floor size ka, mako-consider ang entity mo as micro-entity, kung saan malaya kang makakapili kung full PFRS or PFRS for SMEs. Kapag naman nag-exceed ang threshold mo, meaning nasa ceiling size ka, bukod hindi ka na mako-consider as PFRS for SMEs, ang only applicable lang ang magagamit mo ay ang full PFRS. Small and medium-sized entities. Small and mid-sized enterprise are business that maintain revenue, asset, or number of employee below certain threshold. PFRS for SMEs. The PFRS for SMEs intended for use by small and medium-sized entities. Description of SMEs. Small and medium-sized entities are entities that do not have public accountability, publish general purpose financial statement for external use. Example of external use included owners na hindi po involved sa managing business, existing and potential creditors. Ang mga example po ng small and medium ay retail trade, healthcare and social assistance and construction.
Section 2, Concept and Persuasive Principles.
Objective of financial statement. The objective of financial statement of an SME is to provide information about the financial position, performance, and cash flows of the entity that is used for economic decision-making by a broad range of users who are not in position to demand report tailored to meet their particular information needs. A secondary objective of financial statements is to show the result of the stewardship of management, the accountability of management for the resources entrusted to it. Qualitative characteristic of information in financial statement. Number 1 is understandability. Information should be presented in comprehensible manner to users who have reasonable knowledge of business and economic activities and accounting, and a willingness to study information with reasonable diligence. Number 2 is relevance. Information is relevant if it's capable of influencing the economic decision of user by helping them evaluate past, present, or in the future events, or confirming or correcting their past evaluation. Number 3 is materiality. Information is material if its omission or misstatement could influence the economic decision of user made on basis of financial statement. It depends on the size of an item or error judged. Number 4 is reliability. Information is reliable when it's free from material error and bias and represent faithfully that which is either purpose represent or could fully expected its represent. Financial statements are not free from bias. It be selection or presented of information that intended influence the making decision or judgment. Number 5 is substance over form. Transactions are accounted for in accordance with the substance are not merely their legal form. This enhances the reliability of financial statement. Number 6 is prudence. Due to uncertainty inherent in business, management may need to make judgment on estimate required under condition of uncertainty. When making such judgment, the estimate with the least effect on equity should be selected, such as asset or income are not overstated. Number 7 is completeness. To be reliable, the information in financial statement must be to complete with the bounds of materiality and cost. Number 8 is comparability. Information should enable and ensure compare the financial statement of an entity. Number 5 is timeliness. Information loses its relevance when there is undue delay in reporting. Thus, to be useful information should be provided within the decision time frame. Number 10 is balance between benefit and cost. The benefit derived from information should exceed the cost of providing it. The evaluation of benefits and costs is substantially in a judgment process.
Undue cost or effort. Undue cost or effort exemption is specified for some requirements of the PFRS for SME. For example, on some specified case, an entity is allowed to measure an asset, liability, or equity at cost when the application of the required measurement base imposed undue cost or effort to the entity. Next is financial position. The financial position of an entity is the relationship of its asset, liability, and equity as of a specific date as presented in the statement of financial position. Next is performance. Performance is the relationship of the income and expense of an entity during a reporting period. Entities adopting the PFRS for SME are permitted to present performance in two single financial statements, a statement of comprehensive income or two financial statement and income statement, and a statement of comprehensive income. Section 3 Financial Statement Presentation. Financial statements should present clearly the financial position, financial performance, and cash flow of an entity. Next, compliance with the PFRS for SMEs. An entity whose financial statement comply with the PFRS for SMEs should make an explicit and unreserved statement of such compliance in the notes. Next is going concern. An assessment of the entity's ability to continue as a going concern should be made when financial statements are prepared. Consistency of preparation. An entity should retain the preparation and classification of items in the financial statement from one period to another. Presentation or classification would be more appropriate, or the PFRS for SMEs require a change in presentation. Next is comparative information. Comparative information for the previous comparable period for all amounts presented in the currency period financial statement should be disclosed, except when the PFRS for SMEs permit or require otherwise. Next, materiality and aggregation. An entity should present separately each material class of similar items. Next is complete set of financial statement. A complete set of financial statement of an entity should include all the following. First, statement of financial position, statement of comprehensive income, statement of change in equity, statement of cash flows, and notes. Next, non-presentation of statement of changes in equity. The entity may omit the statement of change in equity and in lieu thereof present a single statement of income and retained earnings. if the only change to equity during the period for which financial statements are presented arise from profit and loss, payment of dividends, correction or of prior period errors, and changes in accounting policy. Next is non-presentation statement of comprehensive income. If an entity has no items of other comprehensive income in any of the periods of which financial statements are presented, it may present only an income statement, or it may present a statement of comprehensive income in which the bottom line is labeled profit or loss. Next is comparative amounts. Since comparative amounts are required to be presented in respect of the previous period for all amounts presented in the current year financial statement, a complete set of financial statement means that an entity shall present as a minimum two or each of the required financial statement and related notes. Next is identification of financial statement. Each of the financial statement and the notes should be clearly identified and distinguished from other information in the same document. In addition, the following information should be displayed formally and repeatedly when necessary. First, the name of reporting entity and any change its name since the end of the preceding reporting period. Second, individual entity or a group of entities. Third, the date of the end of the reporting period and the period covered by the financial statement. Fourth, the presentation currency. Last, the level of rounding. Presentation of information not required under PFRS for SMEs. The PFRS for SMEs does not address presentation of segment information, earnings per share, or interim financial reports by an SME. Such disclosure are normally for entities with public accountability. An SME making such a disclosure should describe the basis of preparing and presenting the information.
Section 4, Statement of Financial Position. The statement of financial position or balance sheet present in entity, asset, liability, and equity a specific date, the end of reporting period. Sequencing of items in the statement of financial position. The PFRS for SMEs does not prescribe the sequence or format which items are not presented. The minimum line items presented above simply provides list of items that are sufficiently different in nature or function to warrant separate presentation in the statement of financial position. An entity may include additional line items when the size of nature or function an item such separate presentation is relevant understanding of entity financial position. The next one is an entity may amend the description of the sequencing of item to the nature of the entity and its transaction to provide information that is relevant to an understanding of entity financial position. The next one is current and non-current distinction. Current and non-current asset and liability shall presented separately in the statement of financial position except when presentation based on liquidity provides information that is reliable and more relevant when presented based on liquidity. All asset and liability shall presented in order for approximate liquidity. Section 5, Statement of Comprehensive Income and Income Statement. Total comprehensive income shall presented either of the following. First one is single statement of comprehensive income presenting all items of income and expense recognized in the period, or in two statements are separate income statement presenting. Section 6, Statement of Changes in Equity and Statement of Income and Retained Earnings. The statement of change in equity included the following. total comprehensive income for the period. The next one is for each component of equity, the effects of retrospective application or retrospective. The next one for each component of equity reconciliation between the carrying amount at the beginning at the end of the period, separately disclosing change resulting from profit or loss, other comprehensive income. The next one, the amounts of investment by dividends and other distribution to the owners in their capacity as owners. Statement of income, retained earnings. An entity may omit the statement of change in equity and lieu, therefore shall present it a statement of income, retained earnings if its only change in equity during the period for which the financial statements are presented arise from. First one is profit or loss. Next one is payment of dividends. The next one, corrections of prior period errors and change in accounting policy. Illustration number 1, statement of income and retained earnings. You can pause the video so you can see illustrating the classification of expense by function. Next one, illustrating number 2, statement of income and retained earnings. You can pause the video so you can see illustrating the classification of expense by nature.
Next is Section 7, Statement of Cash Flows. The Statement of Cash Flows provides information about the changes in cash and cash equivalents of an entity for a reporting period, showing separately changes from operating activities, investing activities, and financing activities. First is operating activities, are the principal revenue producing activities of the entity. Therefore, cash flows from operating activities generally result from the transaction and the other events and conditions that enter into the determination of profit and loss. Second, in investing activities are the acquisition and disposal of long-term asset and other investment not included in the cash equivalent. Third is financing activities, are activities that result in changes in the size and composition of the contributed equity and borrowings of an entity. Reporting of cash flows. An entity shall present cash flows from operating activities using either the direct method or the indirect method. First, the direct method shows the major classes of gross receipt and the gross cash payments from transactions that enter into the determination of profit or loss, and cash flows from the acquisition and sale of investment, loans, and other contracts held for dealing or trading purposes, which are dissimilar to inventory acquired especially for resale. Next, under the indirect method, accrual basis profit or loss is adjusted for a non-cash items and changes in current operating asset and liabilities to determine the cash basis profit or loss, which is equal to the cash flows from operating activities. Foreign currency cash flows. Cash flows arising from transaction in foreign currency shall be translated to the entity's functional currency using the exchange rate at the date of the cash flows. Next, interest and dividends. Interest paid and interest and dividends received may be classified as operating cash flows because they are included in profit or loss. Next is income tax. Cash flows arising from income tax shall be classified as operating cash flows unless they can be specially identified with financing and investing activities. Next is non-cash transaction. The statement of cash flow should include only activities which have result to actual cash receipt or cash payment during the period. Non-cash transactions are excluded and disclosed elsewhere in the financial statement. Section 8. Notes to the financial statement. The notes contain information in addition to those presented in the other components of a complete set of financial statement. Notes provide narrative description or disaggregation of items presented in the other statement and information about items that do not qualify for recognition in those statements. Structure of the notes. The note shall present information about the basis of preparation of the financial statement and the specific accounting policies used, or disclose required information not presented elsewhere in the financial statement, and provide information that is not presented elsewhere in the financial statement but is relevant to an understanding of any of them. Next, cross-referencing. An entity shall, as far as practicable, present the notes in a systematic manner. An entity shall cross-reference each item in the financial statement to any related information in the notes. Next, order of presentation. An entity normally presents the notes in the statement that the financial statement have been prepared in compliance with the PFRS for SME. Section 9. Consolidated and separate financial statement. Refer to Accounting for Business Combination Advanced Accounting 2. Section 10. Accounting policies, estimate, and errors. Accounting policies are the specific principle, basis, convention, rules, and practices applied by an entity in the preparing and presenting financial statement. Hierarchy of reporting standard. If the PFRS for SMEs especially addresses a transaction, other event, or condition, an entity shall apply the PFRS for SMEs. Next, in the making judgment, management should refer to and consider the applicability of the following sources in this descending order. First, the following requirements and guidance in the PFRS for SMEs dealing with similar and related issue and the definition, recognition, criteria, and measurement. B. Concept for asset, liabilities, income, and expense, and the pervasive principle in the PFRS for SMEs. Last, in the making judgment, management may also consider the requirements and guidance in full PFRS dealing with similar and related issues. Accounting for changes in accounting policies. Changes in accounting policy resulting from a change in the requirement of the PFRS for SMEs is accounted for accordance with the transitional provision, if any, specified in that amendment. And all other changes in accounting policies are accounted for retrospectively. Next, retrospective application. When a change in accounting policy is applied retrospectively, the entity shall apply the new accounting policy to comparative information for prior periods to the earliest date for which is practicable, as if the new accounting policies had always been applied. When it is impracticable to determine the individual periods' effects of the change in accounting policies on comparative information for one or more prior periods presented, the entity shall apply the new accounting policy to the carrying amounts of assets and liabilities as the beginning of the earliest period for which retrospective application is practicable. Changes in accounting estimate. A change in accounting estimate is an adjustment of the carrying amount of an asset or liability, or the amount of the periodic consumption of an asset that result from the assessment of the present status of and expected future benefits and obligations associated with asset and liabilities. The effect of the change in accounting estimate is accounted for prospectively by including it in profit or loss in the period of change or in the period of change and the future periods if the change affect both. Correction of prior period error. Prior period errors are omission from and misstatement in the entity's financial statement for one or more prior period. 11. Basic financial instrument. A financial instrument is a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. Accounting fallacies choice. An entity should choose to apply either the provision of both Section 11 and Section 12 of the PFRS for SMEs in the full, or the recognition and measurement provision of PAS 39 financial instrument recognition and measurement and the disclosure requirements of Section 11 and 12. Next, basic financial instrument. Basic financial instrument refer to a non-complex financial instrument. All basic financial instruments should be measured using an amortized cost model except for basic financial instruments that are publicly traded or whose fair value can otherwise be measured variable without undue cost or effort. The following basic financial instruments shall be accounted for under an amortized cost. First, cash. Second, demand and fixed term deposits when the entity is the depositor. Third, commercial paper and commercial bills held. Fourth, accounts, notes, and loans receivable and payable. Initial recognition of financial asset and liabilities. An entity shall recognize a financial asset or financial liability only when the entity becomes a party to the contractual provision of the instrument. Next, initial measurement. A financial asset or financial liability is initially recognized at the transaction price, plus transaction costs except by those that are subsequently measured at the fair value through profit and loss, unless the agreement contributed in a financing transaction for either the entity for a financial liability or the contempt party for a financial asset to the agreement to the arrangement.
Section 12. Other financial instruments issues. Difference in scope of Section 11 and 12. Section 11 applies to basic financial instruments and is relevant to all entities, while in Section 12 it applies to other and more complex financial instruments and transactions. If an entity enters into only basic financial instrument transactions, the Section 12 is not applicable. However, even entities with only basic financial instruments shall consider the scope of Section 12 to ensure that they are exempt. The scope of Section 12 are asset-backed securities such as collateralized mortgage obligations, repurchase agreements, and securitized package of receivables, and option rights, warrants, future contracts, forward contracts, and interest rate swap that can be settled in cash or by exchanging other financial instruments, and financial instruments that qualify and are designated in hedging instruments. Section 13. Inventories. Inventories are assets that is held for sale in the ordinary course of business and in the process of production for such sale. and it also a form of materials or supplies to be consumed in the production process or in the rendering of services. Inventories are measured at a lower cost and estimated selling price less cost to complete and sell. Costs of inventories are the following: the purchase cost, conversion cost, direct labor, and manufacturing overhead, and other costs incurred in bringing the inventories to their present location and condition. The cost of inventories of a service provider is primarily consists of direct labor and overhead. Costs excluded from inventories are the following: abnormal amounts of waste materials, labor or other production costs. B. Storage costs unless those costs are necessary during the production process before a further production stage. C is administrative overhead that do not contribute to bringing inventories to their present location and condition. And lastly, the selling cost of agricultural produce harvested from biological assets. Inventories comprising agricultural produce harvested from biological assets are measured on initial recognition at fair value, less estimated cost to sell at point of harvest. These become the cost of the inventories at the date for subsequent application of measurement at lower cost and estimated selling price less cost to complete to sell. Standard costing, retail method, and most recent purchase price. An entity may use techniques such as the standard cost method and retail method or the most recent purchase price for measuring the cost of inventories if the result approximate cost. Cost formula may be used in measuring the cost of inventories. There are three types. Number one is the specific identification. It shall be used for inventories which are not ordinarily interchangeable. First in, first out, the FIFO, where the cost of goods sold consists of inventories acquired earlier and cost of ending inventory consists of cost of inventories recently acquired. Weighted average cost, where the cost of goods sold and cost of ending inventory consists of average cost of inventories acquired during a period. And the use of LIFO is prohibited. 14. Investments in associates. An associate is an entity over which the investor has significant influence. Ang significant influence ay ang power to participate sa mga decision in financial and operating. Nag-e-exist ito kapag ang ownership ay at least 20%. Measurement, accounting policy election. An investor shall account for all of its investments in associates using one of the following: the cost model, equity method, and the fair value model. Under the cost model, the investor measures its investments in associate at cost less accumulated impairment losses. Under the equity model, the investor measures its investments in associate at the transaction price including the transaction cost. Quoted equity securities are measured using the fair value model. Goodwill is the excess of acquisition cost of the investment in associate over the investor's interest in the net fair value of the identifiable assets, liabilities, and contingent liabilities. It shall be recognized as goodwill and shall be amortized over its estimated useful life. If there is no reliable estimate of a useful life, the goodwill shall be amortized over a period of 10 years. Negative goodwill arises if the investor's interest in the net fair value of the identifiable assets, liabilities, and contingent liabilities exceeds the acquisition cost of the investment in associates. Adjustment to share in associate profit or losses. An investor shall adjust its share of the associate profit or losses after acquisition to account for additional depreciation or amortization. Section 15. Investments in joint ventures. It refers to joint arrangements in accounting for specialized transactions. Section 16. Investment property. Investment property is a property that is land or building or part of a building or both. It is held by the owners or by the lessee under a finance lease to earn rentals for both capital appreciation. Investment property used in the production or supply of goods or services or for administrative purposes or sale in the ordinary course of business. Property interest in operating lease. A property interest that is held by the lessee under an operating lease may be classified and accounted for an investment property. If the property would otherwise meet the definition of an investment property, and the lessee can measure the fair value of the property interest without undue cost or effort of an ongoing basis, this classification alternative is available on a property-by-property basis. Investment property, its initial measurement is at cost, which compromises the purchase price and any directly attributable expenditure. It subsequently measured at fair value at each reporting date with changes in fair value recognized in profit or loss, unless fair value cannot be determined reliably without undue cost or effort. Transfers. If a reliable measurement of fair value becomes unavailable, the investment property is reclassified to investment property carried at cost less accumulated depreciation and impairment until such time that fair value can be determined reliably without undue cost or effort. 17. Property, plant, and equipment. PPE are recognized when it is held for use to the production or supply of goods or services, and for rental to others or for administrative purposes, and it is expected to be used during more than one period. PPE does not include biological assets related to agricultural activity or mineral rights and mineral reserves such as oil, natural gas, and similar and non-regenerative resources. Spare parts and servicing equipment. Items such as spare parts, standby equipment, and servicing equipment ay nare-recognize as PPE kapag na-meet nito ang definition. Kung hindi nito na-meet ang definition, ito ay naka-classified as inventory. The following are classified as property, plant, and equipment. Major spare parts, standby equipment expected to be used more than one period, and spare parts and servicing equipment that can be used only in conjunction with an item of PPE. Replacement of parts. Some of the PPE parts may require some replacement at regular intervals. When a part is replaced, the cost of the replacement is recognized. It is added to the carrying amount of the item of PPE. If the replacement part is expected to provide incremental future benefits to the entity. Letter B. The carrying amount of the replacement part is recognized. It is deducted from the carrying amount of the item of PPE. Letter C. If it is not practicable for an entity to determine the carrying amount of the replaced part, the cost of the replacement may be used as indication of what the cost of the replacement part was at the time it was acquired or constructed. Land and buildings. Land and buildings are separable assets. It shall be accounted for separately. Dahil ang land is normally non-depreciable and ang building naman are depreciable. Subsequent measurement. Subsequent measurement to initial recognition shall choose either the cost model or the revaluation model. The cost model shall be applied to investment property whose fair value cannot be measured reliably without undue cost or effort. Under cost, day-to-day servicing of an item of PPE shall be expensed when incurred. Under the cost model, an item of PPE is subsequently measured at cost less any accumulated depreciation and any accumulated impairment losses. Under the revaluation model naman, an item is subsequently measured at an revalued amount being its fair value at the date of the revaluation, less any subsequent accumulated depreciation and subsequent accumulated impairment losses.